Gold does continue to rise. If gold goes back to 5,000, which I think it will, and then doubles to 10,000, silver should proportionally have a bigger increase. And as people see that, they will buy silver to get that leverage to gold. We're really just started a new bull market in silver. So this is early when it comes to silver. And certainly if silver can go, from when I started buying it in the late 1990s, it was like $4 an ounce. Yeah. And so if it can go from $4 an ounce to $60 an ounce, or it can certainly go from 60 to 200. I mean, that's only a little more than a triple. But it's not even so much silver going up. That will be part of it. But it's really the U.S. dollar going down. It means that you're going to need a lot more dollars to buy silver.
The global financial markets are shifting rapidly as tangible commodities regain their historical dominance over fragile paper currencies. Astute investors are increasingly seeking long-term refuge from systemic vulnerabilities that threaten fiat standards worldwide. Peter Schiff, a well-known financial commentator, author, and global strategist, argues that gold will inevitably climb back to $5,000 before doubling to $10,000, triggering an even larger proportional surge in silver. This looming monetary shift is primarily driven by the terminal decline of the devalued US dollar rather than a simple rise in raw metal values. As the central bank fails to combat core inflationary pressures, a massive economic correction is brewing that will catch mainstream markets entirely off guard. Silver currently represents a fresh, early-stage bull market positioned to easily triple from its current support levels to hit $200 per ounce. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
I think investors, are being fooled by the Fed's rhetoric, by Walsh's tough talk about inflation fighting. I don't believe that he can walk the walk. He did admit that inflation is a choice, and I agree, and it's exactly what he's going to choose. His predecessors chose inflation, and he'll do it for the same reason. Because if you don't choose inflation, then you have to choose something else. And that really is a big drop in the stock market, the real estate market, a recession, financial crisis. You got to force fiscal responsibility on the U.S. government. And none of these things are going to happen. So I think that the markets are not going to get the rate hikes that they anticipate. And even if we do get some hikes, they'll be too little too late, because we need much bigger hikes than the Fed is even posturing that it might deliver, because it's so far behind the curve when it comes to inflation. It's created so much inflation. And in fact, despite the tough talk, money supply continues to grow rapidly. The Fed's balance sheet continues to expand, and they did not increase interest rates when they had the opportunity. In fact, what they did do is they created 5 task forces to study the problems rather than doing something to solve the problems. And that's typically how politicians act when they don't want to do something that's politically unpopular. They just create a committee, or in this case, a task force, and that takes the heat off them to actually do anything. So the Fed is probably not going to do anything for a while. But meanwhile, the economy is weak, the labor market is weak, and interest rates are still rising long term. So there's going to be a lot of political pressure on the Fed to cut rates and to ramp up the quantitative easing program that they don't even admit exists. If you go back to the first time the Fed cut rates after having raised them in 2021, long-term bond yields rose. And that was the opposite of what most had expected. Not me. I had basically forecast that rise in rates. But I think we've already seen that the Fed has lost control of the longer end of the yield curve. The bigger problem is the enormity of the debt, now closing in on $40 trillion, and the trajectory, the rate at which the national debt is rising, with our budget deficits really unofficially clocking in around $3 billion per year, and interest on the national debt, the largest increasing line item, probably going to get to $2 trillion a year sometime next year, go forward pace. So this is completely unsustainable, and the bond market is beginning to price that in, because there's going to be a default. The only question is how. Is it an honest default where the government doesn't pay? Is it kind of a quasi default where maybe they extend the maturities of the debt or lower the coupons or a combination? Or is it just massive inflation? Do they just print a ton of money? But either way, the bondholders are going to lose, and that's why they don't want to buy the bonds. That's why they don't want to hold the bonds. Silver was kind of capped by some overhead resistance going back to 1980 at around $50, and it was turned back in 2011 before it could reach that peak. Even though gold more than doubled its 1980 high, it was almost at 2000. Silver didn't get up there. And then when gold broke through 2000 and went to 3,000, 4,000, silver really did nothing. It kind of was going sideways. And silver at one point got to an all-time record lows, well over 100 ounces of silver per 1 ounce of gold. And then all of a sudden, silver exploded, and it really went from 30 to 120. It went up 4x in a very short period of time. So it was obviously unsustainable, way overbought, had to pull back at some point. And the catalyst was the breakout of the Iran war, and that started it. But, I think silver has pulled back. Right now, it's back above $60 an ounce. I don't expect it to go back below 50. So I think the old resistance is the new support. And we're really just started a new bull market in silver. So this is early when it comes to silver. And certainly if silver can go, from when I started buying it in the late 1990s, it was like $4 an ounce. And so if it can go from $4 an ounce to $60 an ounce, or it can certainly go from 60 to 200. I mean, that's only a little more than a triple. But it's not even so much silver going up. That will be part of it. But it's really the U.S. dollar going down. It means that you're going to need a lot more dollars to buy silver. You're going to be a lot more dollars to buy everything. So why should silver be excluded? I think that silver is going to go up even if we weren't creating inflation. I think based on all the new demand for silver, all the new uses for silver, with the huge increase in demand for power and electric power, and where silver is useful in that whole process, that means there's going to be a lot more demand for silver. There's just not a lot of supply. So just its own dynamic of supply and demand, absent inflation or any monetary premiums that start to build into silver, I think the price of silver is going to go up, just like the price of copper is going up. I mean, copper prices hit record highs. People aren't using copper as a store of value or as money, but they need copper, and for the same reason they need silver. Now, there's industrial demand for gold too. There's plenty of it, but there's a lot more of a safe haven store of value. And central banks are not storing silver, they're not storing copper, but they are storing gold. But silver's got both going for it, and so I think you're going to see more industrial demand and more investor demand as an inflation hedge, as a levered play on gold. Because if gold does continue to rise, if gold goes back to 5,000, which I think it will, and then doubles to 10,000, silver should proportionally have a bigger increase. And as people see that, they will buy silver to get that leverage to gold.
The illusion of monetary tightening is unraveling as the central bank remains deeply behind the inflation curve. Fiscal discipline is politically impossible, meaning projected interest rate hikes will be completely inadequate. This failure guarantees an impending sovereign debt default, leaving bondholders facing catastrophic losses as national debt closes in on $40 trillion. Whether through a refusal to pay, modifying maturities, or hyperinflationary money printing, the ultimate erosion of wealth is certain. Meanwhile, long-term bond yields are destined to rise as market forces overpower central planning, culminating in political pressure to expand quantitative easing. Paper assets will see paper gains vaporized when the domestic stock market bubble inevitably bursts. Hard assets remain the only mechanism for preserving purchasing power through this looming generational financial crisis. Now, let's get back to the interview.
There's a lot of complacency surrounding that and the dollar status. We kind of take it for granted in the United States, and part of it is the arrogance or hubris, involved. And we think there's really no alternative. We think the world is kind of stuck with the dollar, like our dollar, your problem, because they don't see an alternative. Like, well, what are you going to use, the euro? I mean, look at the yen. You can't use the yen. The British pound, well, you can use that. Or, the Chinese, you're going to trust them. But the reality is, and I've been saying this for many, many years, you don't need the fiat currency. You just use gold. And I think that's what's happening. The central banks are de-dollarizing into gold. gold is the replacement for the dollar because gold was the reserve before it became the dollar. And in fact, the only reason the dollar achieved that status in the first place was because of its gold backing. And not only was it backed by gold, if you owned dollars, you had a claim on gold that you could exercise whenever you wanted. It was an IOU for gold. And the dollar itself was really a weight of gold. So we went off that in 1971. And so the world has kind of been on this fiat standard. But now they can go back to gold. They can go back to backing their currencies with something real instead of with just, the worthless promises of the United States to pay you nothing. The opportunity cost is being grossly exaggerated because, first of all, when I started recommending that people buy gold, in a professional capacity, but when I started it, it was the late 1990s, and gold was under $300, and silver was, $4. So if you bought gold for $300 and now it's $4,000, it's not like you missed out on any gains. You actually got better gains than the overall stock market. Now, did gold beat every stock that you could have bought? Did it, No. There are stocks that went up more than gold. But if you just bought the S&P index, gold beat it. So did silver. So investors haven't missed out on gains by being in gold and silver. They've missed out on gains by being in cash. So if you just stayed in cash the last 20 years, yeah. But I never advocated that. Now, I didn't tell people to only own gold and silver. So I told people to own stocks too. I just mainly focused on foreign stocks. Now, in aggregate, those stocks have not done as well as U.S. stocks, but they've paid much higher dividends that we've been able to collect over the years. And some of our foreign stocks have done better than the average, U.S. stock. But on average, no, the U.S. market has outperformed. Although over the past few years, that's not been the case. In fact, last year was the biggest year in my career for outperformance of foreign stocks versus domestic. So, I'm not one of those so-called perma bears that just says, hold all your money in cash. Yes, I'm bearish on the U.S. economy, the macroeconomic fundamentals. I think the U.S. stock market is overvalued, and therefore I don't think it represents a good investment. But I offer real alternatives that also provide good returns. And ultimately, I think that a lot of the gains that investors have on paper who stayed invested in the U.S. stock market bubble are going to lose those gains when the air comes out of the bubble. So at the end of the day, it doesn't, if you're playing poker and you win a few hands and you got a big stack of chips, but when you leave, you're broke, the fact that you were ahead for a while is meaningless to what ultimately happened. And I think the same thing is going to happen with a lot of American investors. They're going to give up a lot of their gains. Meanwhile, the U.S. bond market, which I've told people not to buy U.S. bonds, U.S. bonds have been a disaster. The yields have been very low, and inflation has destroyed the value of your principal. So anybody who bought foreign stocks instead of bonds, because I told people instead of buying bonds, buy high dividend paying foreign stocks, and they way outperformed the U.S. bond market. So my investment advice over the last decades, even though it's been premature in that we haven't had the complete collapse of the U.S. financial system, the dollar hasn't crashed, right? The bond market hasn't crashed. My investment advice has been sound. Could you have done better if you went all in on Bitcoin for the beginning? Sure. But you took a tremendous amount of risk to do that. And anything, with the benefit of hindsight, or you could have just bought all the Mag 7 stocks. But how many people actually did that? So, and it would be very reckless and irresponsible to do that. Yes, now that we know the outcome, it's easy to say, I could find a winning lottery ticket and say, well, you should have bought that, right? It's easy. You should have played these numbers. Yeah, but how do you know that those are the numbers that are going to come up? You only know after the fact. So, I'm not a Monday morning quarterback. I'm telling people what to do, like on the field, right? In real time. And so yeah. I think the advice is sound. And I think the financial collapse that I have been warning about for a long time now is coming. And it's just going to be worse than it would have been had it happened a decade or two ago, because the problem is much bigger now than it was then. Yes, we succeeded in kicking the can down the road and delaying the day of reckoning. But because we did that, there's a lot more to reckon with. So, it's even more important to be prepared in advance for the crisis.
Beyond the macroeconomics of failing fiat structures lies a profound physical supply and demand squeeze that will independently drive industrial precious metals to historic record highs. Global manufacturing utilization is accelerating rapidly due to exponential clean energy demands and massive grid electrification, turning historical overhead resistance points into permanent technical support floors. Copper has already blazed this exact trail by reaching unprecedented price peaks, and silver is fundamentally positioned to mirror this explosive upward trajectory based on raw commercial necessity alone. Simultaneously, central banks worldwide are aggressively de-dollarizing their foreign balance sheets, entirely bypassing traditional paper reserves to directly accumulate physical gold. This paradigm shift confirms that a massive, inevitable financial collapse is accelerating, promising a far more severe day of reckoning, because underlying economic blockages were temporarily kicked down the road. When the global currency bubble finally deflates, holding tangible commodities will separate protected generational wealth from total paper asset ruin. The data indicates that silver will comfortably exceed previous multi-decade limits. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.